So let me get to a friend of our show, the CEO and co-chief investment officer at Pimco, Mohamed El-Erian. He's just written an op-ed for the Financial Times about the debt deal, and I just want to pull out one quote from this op-ed. He said, look, this time is different. Those responsible for America's multi-month debt ceiling debacle deserve at best an incomplete. They could even merit a fail grade if both the process and outcome inflict the type of damage to America and the global system that I suspect that they will. Mohamed, great to have you join us again. You say, and you've been very vocal in the last 24 hours, that we are worse off now than we were before the debt deal was passed. Why?
Betty, when you think of an input-output ratio, how much effort went into something and what the outcome is, a tremendous amount of effort went into this debt ceiling compromise. And we broke a lot of things in the process. We demonstrated to the rest of the world how dysfunctional our politics are. And then you look at the output. Well, it's not a complete deal. Key issues haven't been addressed. They've been pushed into November. The operational details aren't clear. And it's not even clear that this was enough to preclude a downgrade by S&P. So at the end of the day, we created a lot of damage. We didn't get an output that we wanted. And in the process, we're undermining household, business, and international confidence. That's why this whole element is a debacle. And I think it's key, and you said at the top of your show, this was manufactured. This was self-inflicted. We didn't need to go through all this.
But Mohamed, we talked about this several weeks ago. I mean, wouldn't it have been even worse, though, if we didn't get this debt deal passed?
It would have been worse if we didn't get it passed, but we had an opportunity to do something. We had an opportunity to look at public, financial, and fiscal reform in the context of an overall package to improve growth, to improve employment, and to put us on a better path. And we missed that opportunity.
Okay. So then, Mohamed, when you say worse off then now, even with this debt deal, what are we talking about here? Are we talking about a double-dip recession?
Well, Bloomberg is reporting today that more and more people think that risk is going up.
Yeah.
You have Larry Summers saying it's 1 in 3. You have Martin Feldstein saying it's 1 in 2.
What do you say?
People are wrecking. We look at this. We think that if we can maintain this middle, it's a 1 to 2% growth rate going forward. However, there's this fear of stall speed. So think of a plane. If a plane is not going fast enough, it ends up by coming down. And the risk we're facing right now is that at 1 to 2%, that may not be enough for an economy that still needs to safely delever. So we're going to get one of two outcomes. Either the Fed is going to be pulled in again with some pretty imperfect policy instruments, or the risk of recession goes up.
And how would you handicap it? You think the Fed's going to step in then?
I think it's going to be a really hard discussion at next week's meetings, and in particular in the run-up to Jackson Hole. Because on the one hand, their two mandates are not going to be met. On the other hand, they recognize that their instruments are not as effective and involve a lot more risk and cost than they have in the past.
Mohamed, really quickly, then, given all of this, I know you've warned about a downgrade. How much more of an increase in the chance of a downgrade do you see?
Well, first, only S&P can answer that question. They have our sovereign rating on negative watch, which is a presumption of a downgrade. We're waiting to hear what they're going to do. We suspect they're under tremendous pressure not to downgrade. But if they stick to what they told the world on July 14th, they would downgrade the U.S.